My portfolio is, well, it's built for some pretty massive upside. I own companies like BigBear.ai, which, let's be honest, loses money every single quarter, and Nebius Group, which is a really high risk bet on AI infrastructure. With about 86,000 pounds of my own money on the line, yeah, the potential for a 10x return is absolutely there, but so is the massive, gut wrenching volatility. And that brings up a really important question.
Right? That volatility, it leads to the number one question I get asked pretty much all the time. People look at these risky holdings and they ask me, "Joe, isn't this just gambling? How in the world do you sleep at night knowing that a 50% drop could literally change your life?" And look, it's a totally fair question. The answer isn't that I'm just some cowboy who's okay with losing a ton of money. The answer? It's structure. That's it. I'm not just closing my eyes and throwing money at exciting ticker symbols. I manage all this risk with a very specific framework that lets me chase those huge returns without exposing myself to what we call ruin risk. It's a strategy I call the bucket system, and today I'm going to show you exactly how it works. Okay, so before we even think about buying a single stock, before a single pound goes into the market, we have to talk about the absolute foundation of this whole thing. It's what I call the life moat. Seriously, this is step 0. You have to have this in place. For me, that life moat is 10,000 pounds in cash, just sitting there, completely outside of the stock market. This isn't an investment. Think of it as insurance. It's insurance against the single biggest wealth destroyer for regular retail investors. And that destroyer is something called forced selling. Just picture this. The market absolutely tanks, and right at that same moment, you lose your job. If you don't have a cash reserve, what do you have to do? You're forced to sell your stocks at the absolute bottom just to pay the rent. The life moat stops that from ever happening. It turns you into a forced holder, which means you can ride out the storm because your real life expenses are already covered. And let's be crystal clear on this point. This 10,000 pounds is not dry powder that's just sitting there waiting for me to buy a market dip. No, that's a totally different thing. This is a life moat. Its only job is to protect my actual life, my rent, my bills, any emergency that comes up, so that my investment portfolio can be left alone to do its job without me raiding it out of sheer desperation. All right, so with the life moat full and secure, now we can finally talk about the portfolio itself. This is really the core of the strategy. I mentally and strategically divide every single pound I invest into 3 completely separate buckets. Each one has a different job and a different risk profile. So this right here, this is the big picture, and I want you to just notice the balance. The vast majority, a full 60% of the portfolio goes into what I call anchors. Then the next 25% is used to fuel the growth engines. And only then, only a small, very carefully contained 15% is allocated to the super high-risk venture bets. This strategic allocation, well, that's the whole key. So let's break down what each of these buckets actually does. The anchors, they're the bedrock. These are companies like SoFi, AMD, and Meta that I have very high conviction will still be around in 10 years, no matter what happens in the economy. They provide the floor for the whole portfolio. Then you have the growth engines, like Palantir and Abuse. These have massive, massive upside, but they're what you'd call priced for perfection, and they come with way more volatility. And then finally, the venture bets. These are my zero or hero plays, like BigBear.ai. They could absolutely go to zero, but they could also be a 10 or even 20x return. But look, just having the buckets, that's not enough. The real magic, the part that actually lets you sleep soundly at night, is all about position sizing. It's about making sure the amount of money you risk perfectly aligns with the bucket that it's in. You can't just throw money around randomly. The size of your bet has to match the level of risk. And this slide right here illustrates that concept perfectly. See, my anchor positions, they're heavy, like my 19,000 pound stake in SoFi. A 10% drop there, yeah, that has a real impact. But then on the other side of the scale, you have a venture bet, like my tiny position in a speculative battery company called SES.AI. That's only about 1,200 pounds. If that company goes to zero tomorrow, I only lose 1.5% of my entire portfolio. Yeah, it'll sting, but it's not going to kill me. This is how you contain risk. I see people all the time putting 50%, sometimes more, of their entire net worth into some speculative penny stock. And frankly, that is financial suicide. You have to contain your high-risk bets. For me, all of that zero or hero stuff, the things I lovingly call my trash, it's all kept inside a small, manageable 15% box. It can't burn down the whole house if it's kept inside that box. So I've got my life moat, I've got my buckets, my positions are all sized correctly. But there's one final step I always take to make absolutely sure I can truly sleep at night. I actively try to break my own portfolio. I run what's called a pre-mortem, basically a stress test against an absolute worst-case scenario.
And I actually do this using my AI agent. This is the exact prompt I give it. I tell it to imagine a future where everything has gone completely wrong. The AI bubble has burst, every single one of my speculative venture bets has cratered to zero, and all my high-growth stocks have been cut in half. I want to know, what's the damage? And the result of this simulation, this is the ultimate confidence booster. Because even in that catastrophe, the portfolio is down, for sure, but it is not out. The venture bucket is completely wiped out. The growth bucket is decimated, but the portfolio survives. And why? Because that massive 60% allocation to the anchors, to SoFi, AMD, and Meta, they hold the line. They are the bedrock that weathers the storm. And that, right there, is the answer to the original question. This is how you sleep at night. It's not about avoiding risk. It's about building a structure that is so robust, so stress-tested, that you know you can survive the absolute worst the market can throw at you and still give yourself a shot at those life-changing returns. So, I'll leave you with this one final thought. It's the golden rule of this entire system. Before you go out and buy that super speculative, exciting stock, you have to ask yourself one question. Have you earned the right to speculate? Have you built your life moat? Have you filled up your anchor bucket? Because speculation, my friends, is a luxury. It's a luxury you can only afford after you've built an unshakable foundation.